So I'm sure you've heard the phrase, over the short term, the markets are a voting machine, but over the long term, they are a weighing machine. And this video is going to be a prime example of that. I'm going to be going over a company that has really not seen its operations impacted whatsoever. In fact, if you look to this chart here, this is the free cash flow generation of this company over the last 10 years. We can see in 2015, they generated around $383 million in free cash flow. Fast forward that to today, and they're at $2.5 billion for a 21.45% compound annual growth rate. I mean, the stock that is compounding free cash flow at a 21.5% pace is actually going through the largest drawdown in its history. And that company is Constellation Software. I'm going to be going over the company's earnings in this video. I'm going to be highlighting some areas where the company is doing very well, where the company, might not be doing all that well. And just overall, I'm going to be giving my thoughts into arguably the best compounder in North America over the last 20 years. I mean, if you invested even something like $10,000, $20,000 in this company during its IPO, you're pretty much retired off this single investment. And the company is now trading at a much more attractive valuation. So I'm going to dive into its earnings, and I'm going to give my thoughts on the company overall. And Constellation is one of the larger holdings inside my portfolio. I have held it for quite some time. If you want to see the top holdings inside of my portfolio, there is a link down in the description. You can grab that report absolutely free, or if you want any of the other free resources I have down in the description, just takes a few seconds to get them. They are going to make you a better investor. And as always, like the video, subscribe to the channel, comment down below. Let me know if you are buying this blue chip tech stock on a massive sale that it's on right now. So the main issue with Constellation Software right now is the fact that a lot of people believe that artificial intelligence will cause some of its clients on some of its vertical market software platforms to kind of create their own systems to run their, mission critical tasks for the company, because this is effectively what Constellation does. It acquires a ton of vertical market software companies, which are companies that provide software to very, very niche industries, so very specific tasks that companies need done. So they work with a wide variety of companies. We're talking, government agencies, healthcare companies, law firms, accounting, things like that. I'll actually show a picture here of a Constellation Software piece of software, vertical market software, that is still being used by a law firm today. And if you look at the picture, it looks like it's from the 90s, because it effectively is. These pieces of software are so specific that these companies still utilize what looks to be just archaic software because it is so mission critical. And the company is drawing down at such a large scale because the market believes that artificial intelligence will make coding these pieces of software very easy. So this gives me a lot of Alphabet vibes back in 2023, 2024, when Alphabet went through a huge drawdown because it believed that ChatGPT, or at least the market believed that ChatGPT was going to replace the business. Google search was going to suffer. People were going to go to ChatGPT instead of Google, in terms of, their ad revenue was going to be hit because of this. YouTube was going to suffer because of AI, kind of slop content. People weren't going to go on that. And again, I added a ton of Google shares during that drawdown because it was just completely overblown. AI was not going to replace a company like Alphabet over the short duration. I mean, even LLMs right now, they're useful, I guess you could say, but for the most part, they're still pretty bad. I mean, I'm not really depending solely on them. I'm utilizing them a lot more, but I'm also finding that I'm utilizing Google, especially their AI functionality, their LLM that is imprinted right on Google now. And it's, they kind of went from, obviously, the market believing they're going to be replaced by AI to being quite possibly the leader in AI. And now you see the company, not only rebounding from that drawdown back in 2023, 2024, it's going to all-time highs continually and is one of the best Magnificent Seven stocks over the last while. So you can benefit from, negative sentiment like this. You do need to acknowledge that the risks exist. The fact that Constellation Software could be replaced by AI, that risk definitely does exist. It is not a 0% chance, but you also need to understand that the market often rides a lot on pessimism like this. It will typically punish a stock way more than it deserves. And although I think that the market is fairly efficient at valuing companies based on earnings, based on, free cash flow generation, sentiment is something where you can definitely get an advantage because the market is typically overly bearish when it fears that capital or, shareholder value will be lost quickly. And I think in terms of Constellation Software, we are seeing one of those cases, which is why I've been continually adding to my shares. When we look to the 10-year chart here, we can pretty much see it's been up and to the right until very, very recently. When we're looking at May, where the company started going through a massive slide. So this is actually the worst drawdown in Constellation Software's history. It's down over 30% from its highs. It is pretty impressive that a company like Constellation in the tech sector only has a max drawdown of around 30%. I mean, prior to this drawdown, it was under 25%. Since 2006, this company had only fallen in price by 25%. That was the max it had ever fallen, which kind of shows how reliable this company really is. This company has been a very low volatility technology company that has provided insane returns, but is now going through a period of the largest volatility in its history. So is the issues, the headwinds, the fears of this company justified? I would argue no. And if we dive into the company's results, it was a very good quarter. And the one thing you do need to understand, if you are new to Constellation Software, you're kind of looking to analyst estimates or headline numbers to kind of judge whether or not it is a good quarter. This is generally not where you're going to want to go. The analyst estimates are all over the map with this company. There's often times where it can miss earnings estimates by a country mile and revenue by a country mile. Realistically, there are a few select things you want to be looking at with this company. I'm going to dive into them right now. So if you look at revenue on the quarter, $2.9 billion. So that is a 16% bump and pretty healthy considering expenses only rose 14%. When we look to the 9 months, which is probably a more accurate indicator of Constellation's success, and I will speak on this a bit, it'll make a lot more sense in a few seconds, but when we look to the 9 months, we're looking at revenue of $8.4 billion, which is a 15% increase, and we're looking at a 12% increase in expenses. Now, the one thing you're going to notice on the income statement for a company like Constellation, you're going to notice a ton of amortization of intangible assets. So this came in at $307 million, which is 13% higher. And through the first 9 months of the year, we're going to have $865 million. So we're probably going to hit $1 billion in amortization of intangible assets. This is effectively a non-cash cost, which will reduce their net income. And what exactly is this? Well, Constellation acquires a lot of these vertical market software companies, and they often end up paying more than fair value of the actual software itself. And that's not to say they're overpaying. They're just paying for intangible assets, which effectively could be things like client relationships. It could be things like brand power, which effectively make the company a lot more valuable, but are on an intangible basis. Like they are not a tangible asset like a vehicle. They are more a intangible asset like, say, a patent or something like that. So this is why I'm going to say if you're new to Constellation, the income statement is probably not going to be where you want to look. And the reasoning for this, if you go to net income, you're going to see $162 million in net income. Now, if you come back to Constellation's Y charts here, you can see that it trades for a market cap of around $71 billion. What is a company with $162 million in net income trading for $71 billion for? And this is because of all these non-cash costs and, accounting, I'm not going to say tricks, but accounting, systems that go in place with a company like Constellation that kind of makes net income not the best thing to look at. Now, what do you want to look at? Well, you want to look at two main things. You want to look at operating cash flow and you want to look at free cash flow available to shareholders. So when we looked at these numbers, the company is growing very, very well. It's growing faster than most of the big tech companies in the US. We look to operating cash flows. We're looking at $685 million. That is 33% increase from Q3 of last year. And when we look to the first 9 months of the year, we're looking at $1.9 billion. That is a 28% bump. Now, free cash flow, you're going to see pretty similar numbers, $529 million this quarter compared to 362 Q3 of 2024. So that's a 46% bump. And then when we look to the first 9 months of the year, we're looking at $1.25 billion. That is a 27% bump from last year. So you're looking at a company that is growing free cash flow at a 27% pace through the first 9 months of the year. And when we come here to this chart, I mean, free cash flow has been increasing at that steady pace as well. So ultimately, there was nothing really wrong with the quarter on a reporting basis. And the one thing is I am recording this over the weekend. Constellation reported earnings on Friday. I would be shocked, and you will see this after Constellation opens, so you'll know if I'm right or not. I would be shocked if they don't open pretty solidly in the green based off this quarter. Sentiment-related headwinds might kind of keep it in the dumpster, but really, realistically, I kind of want it to stay there so I can keep buying more shares, but it'll be interesting to see where it opens at on Monday. Now, the next thing I want to go over is organic growth. This is going to be another very important key performance indicator, KPI, when you're looking at a company like Constellation Software. And why is that? Well, this company makes a lot of acquisitions. The prime avenue for growth is acquisitions. So we can look to organic growth to see how much the underlying companies it acquires are growing after they kind of acquire them and let them do their own thing, because Constellation does run a decentralized business model, which means it acquires these companies and they effectively keep everybody on board and the company just operates as it would. So when we look at the quarter, we're seeing organic growth of 5%. This is pretty typical. This is in line as to what Constellation usually reports. When we come to the chart here and we can go to the segments and KPIs for Constellation, and we can go to organic growth and we go to quarterly here, we're going to see that it's relatively in line with what the company typically has reported. In fact, it's much higher than what it has reported over the last, 3-4 quarters here. So that's a good sign. And the most important thing when it comes to organic growth is the maintenance and recurring revenue. Now, you might come here, this is in Constellation's just quarterly results, MD&A. You're going to see organic growth and you're going to see declines in particular areas. I mean, we can see professional services, they actually decreased. We can see hardware and other, it decreased again. And you're going to see, numbers kind of all over the map for these segments. The most important segment you need to be looking at for a company like Constellation Software is this maintenance and recurring revenue. So the reasoning why, well, you can see here it makes up $2.2 billion of $2.9 billion in revenue. So we're talking about 76% in terms of overall revenue. So this is going to be where you want to see the organic growth at its strongest and at its steadiest. And at this point in time, it certainly is 6%. And why I say this, we go to the 9 months of the year, we can see that it is effectively the only area of the company that is growing organically. We can see flat in licenses, -3% in professional services, 0% in hardware, and 5% in maintenance and recurring revenue. And when we look to the most profitable segment of the business, it is maintenance and recurring revenue. So the backbone thesis for Constellation is growth in this area. It could decline, I wouldn't say meaningfully in all the other segments, but the one thing that would really change my mind about this company is if it started declining in maintenance and recurring revenue. That would be thesis changing for me, but it really has not occurred. Now, when we look to the 9-month organic growth rate, we're looking at 3%. However, if we come down here, we can see that the company kind of went through a lull. We're looking at 2%, 2%, 2%, 0%, and then it's jumped back up to 5%. So what is probably dragging this down a bit? Because we're looking at this would be through the first 9 months of the year. This 0% is kind of dragging it down. I would imagine we're going to see that tick up in the fourth quarter if it does report 5% organic growth rates again. So this number I'm not overly concerned with. The one main thing I want to see is this maintenance recurring revenue stay strong. Stay, 5, 6, 7, 8, anything like that. And even then, I'm looking over the long term. Even a single quarter isn't really going to bother me all that much. So the final thing I'll go over with the quarter before I speak on valuation is the acquisitions. So the company used around $955 million in cash to acquire businesses throughout the year. So the first 9 months of the year, this is down a little bit from last year. They were $1.05 billion last year. However, this is still a very, very good rate of capital deployment. And overall, when we look to the company's acquisition activity, we can come here to the cash flow statement and we can look to cash used in acquisitions and we can look to the last 12 months. This company is laying out capital for acquisitions at pretty much one of the faster paces it has been in history. Now, it has slowed down over the last, year or so after making some big splashes in the market in 2023, 2024, but it still has a very healthy rate of acquisition activity, which is a good sign. But this was a very, very good quarter. And before I give my final thoughts, I do just want to speak on valuation. So with this company's income statement being very convoluted, very confusing, a lot of non-cash charges, you want to be looking at price to free cash flow as one of the main methods of valuation. I mean, when we come here in terms of valuation, I'll zoom in on this a bit. We're looking at 82x trailing 12-month earnings. So to a lot of people, this is going to seem ridiculously expensive for a company growing at its pace. However, when we come down to price to free cash flow, we're looking at 22.37. And the one thing you need to be looking at is historical averages. So when we look to a 10-year median average, we're looking at 27x free cash flow. When we look to a 5-year median average, we're looking at 30.7. So this company is trading at a massive discount now to its historical price to free cash flow numbers because of those AI headwinds. Now, why do I look towards the 5-year median average more than the 10? Well, primarily because Constellation has been deploying capital at a faster rate over the last half decade than it has over the 10-year median average. So I tend to look at that 5-year. And at this point in time, it is trading at a near 30% discount to its 5-year price to free cash flow valuation. So effectively what this is saying is if you bought the stock today and it went back to that 5-year median average in terms of valuation, you would make 27%. And that wouldn't even include any sort of earnings growth or free cash flow growth or anything like that. This is a big discount for a company that really does not typically go through this type of volatility. I mean, when we look to the price to free cash flow overall, we're looking at before the drawdown, you can see it was trading at 42.5x free cash flows. Now we're gone down to 22.37. So this company's valuation has been wiped out nearly in half just because of the potential fears in terms of artificial intelligence, kind of taking a bite out of the company's business, which it really has not shown as of late that it has done this whatsoever. So what are my thoughts on the quarter overall, and what are my thoughts on the company overall? Great quarter, great company. I continue to buy even more aggressively now than I was over the last while. The one thing, this company is going to be going through some big volatility as of late. We've seen it. This is not a company with a ton of, I guess you could say, volume in terms of shares moved. And there's also a lot of, situations like Questrade where they have fractional shares, but you cannot buy fractional shares of Constellation. You can do it on Wealthsimple, but not on something like Questrade. So I have noticed with the large amount of volatility in the company, there's a lot of spread in terms of their share price. I've even noticed it sometimes as high as $200 or $300. So the company's been pretty bonkers as of late, but I mean, the cheaper it goes, the more I'll buy. I will be continuing to buy this company. I will be continuing to buy Topicus. I think the market is blowing this way out of proportion, and we now have one of the best technology companies in North America over the last 2 decades that is trading at a substantial discount to what it typically trades at. Now, I do want to mention it is not a 0% chance that AI does not disrupt this business. It is definitely a possibility. However, I just think the market is kind of treating it as more than a coin flip in terms of the favorability of AI disrupting the business, rather than, my odds being much, much less than a coin flip. There is a chance that this company does take a hit from artificial intelligence, but the management team at Constellation is so strong that I would actually bank on the fact that management is going to be able to turn AI into a tailwind for the company and actually utilize it to grow free cash flow and grow earnings rather than be disrupted by it. So for that reason, I am accumulating this company. I'm doing this with a company like Topicus as well. I have talked about Topicus in a previous video. So again, I'll leave a link above. You can watch that video, but these have been 2 companies I've been aggressively adding over the last while they kind of remain in the dumpster. And as always, if you want to know more about this company, you need to do a bit of a deep dive. It's definitely a complex company. It's not a company that you need to go hardcore into. I am not like a lot of people who, the hardcores that analyze every single acquisition this company makes and knows every single underlying company inside and out. I more so follow the broad business model of the company. I know of the large scale acquisitions to make, but I kind of let management do its own thing and kind of reap the benefits. So everybody, hope you like the video. Head down below, like the video, subscribe to the channel, comment down below. Let me know if you're buying Constellation software today, or if you think it's going to fall further, or if you think, AI will disrupt the business. I definitely want to hear from you. So drop that comment and stay tuned for more great investing content.